Hi, I'm Bob Braun. I'm a partner at Jeffrey Mangels, Butler & Mitchell. I'm here at Meet the Money 2015, our 25th anniversary. And I'm here with Bill Sipple, who is the Executive Managing Director of HBS Capital. Bill, thanks for coming by and talking with us.
It's good to be here. Thanks.
Bill, wanted to start out by asking you, what kind of opportunities do you guys see out in the marketplace, and what are you doing about those? How are you trying to take advantage of those?
Well, HBS Capital is the investment banking arm for HBS International for the Americas and the Caribbean. So we do three things. We do debt and equity placement, we do asset sales, and then we do what I call capital advisory work. So in good times, that will be things like loan workouts and loan modification, or bad times rather, loan modifications and workouts. In good times, it'll be franchise searches and that sort of thing. So from an opportunity standpoint, we're really transaction oriented. I think today's opportunities, on the capital market side of the business are really the ability to put long-term, low-cost, fixed-rate financing on assets that you either intend to sell in the short term to provide an accretive part of the transaction, or assets that you plan on keeping for a longer period of time. So there's, from a financing perspective, there's really good, cheap, long-term debt for stabilized properties. Secondly, from the standpoint of asset transactions, I think we've still got enough runway in this particular market to where you could sell an asset today or buy an asset today and still have time enough within the cycle to be able to capitalize on the transaction as you would execute today.
That's great. Are there any particular market segments or chain scales that you are looking at it being particularly attractive now?
We've been seeing in this particular cycle, we've been seeing an awful lot of activity in the better segment, better part of the limited service or select service segment, I should say. So the top 3 or 4 brands, their select service products have been pretty popular in both primary and secondary markets. We're starting to see some more interest in tertiary markets because of the competition in the primary and secondary markets. So I think there's been a lot of opportunity in those. Full service properties have had moderate activity and interest level from the standpoint of institutional buyers. And then you've also had, I think, very good rebound over this particular cycle in the luxury segment, and you're starting to see even more activity in the luxury hotels.
So it feels like it's hitting on all cylinders, really.
Yeah, I think there's only one market segment that hasn't seen, or product segment, I should say, that hasn't seen a tremendous amount of growth, and it's at the lower end of the market.
So, okay, the truly lower end limited service properties?
Right.
Okay. And you mentioned, are you actively looking at what's happening in tertiary markets or are your clients looking at that? Or?
We're financing we actually have deals in all 3 markets, tertiary, secondary, and primary markets at this time.
And you mentioned, are you doing a lot of work in the Caribbean now or in Latin America?
We have 3 engagements going on in the Caribbean right now. The Caribbean is an interesting aggregate, if you aggregate the Caribbean, right? It's generally the first market that falls off the table when the market turns, and it's usually the last one to come back. There's a tremendous amount of activity, and the activity in the Caribbean right now and over the last, say, 24 months has really been busted projects that people are picking up and trying to complete from the last downturn.
Interesting. I would imagine that one of the things that drives you and drives your business are going to be interest rates, and they've been awfully low for a long time. Where do you think they're going, and how do you think that's going to impact your business, your ability to execute on your plans?
Well, interest rates and the prediction of interest rates is kind of like marketing dollars, like advertising dollars. We know half of all advertising dollars have an impact. We just don't know which half. So we know interest rates are going up. We just don't know when.
Right.
It'll happen probably this year, I would think. How much it goes up and how much it impacts, the business and the transaction activity is yet to be seen. We know it will have an impact on cap rates and pricing. There's, I think, nobody doubting today that interest rates are going to see some increase, but I don't think anyone's predicting a large increase. So I would expect it to have some nominal impact on transaction activity.
Yeah, I'm wondering, going back to your comment, just struck me on the really lower end properties. Do you think there are opportunities there because there just haven't been a lot of attention paid to them, or do you just think that's an area that that's languishing on the vine for good reason?
Well, I don't know that, I don't think any particular segment of the market is struggling. So I think there's been more interest in what I would call income efficient properties, which are the select service, higher end select service brands, if you will. And so there's a lot of as I said, income efficiency in that segment of the market. And so there's been a lot of interest and a lot less operational risk. The lower end of the market, and you can actually have projects that get to the point where you can have critical mass in terms of the project size. So we think in terms of how easy is it to put capital out into a project. If it has scale, then you have the attention of a number of different capital sources. If it doesn't have scale, then it's very difficult to get the attention of capital sources. So the challenge that you have with the lower end properties is the scale of the investment is so small that it's really a friends and family kind of an equity play as opposed to an institutional equity play. So in that case, it's harder to find interest, it's harder to gain scale. The only way you can actually gain scale is through a portfolio acquisition, like some of the ones that have happened.
So I'll ask you to do a little bit of prediction since you opened up the question about the runway in the market. A lot of people you can pretty much make book on this, I think, in London as to how long the market is going to last or how long the cycle is going to last. Do you have any feel for this? Is this a 1 or 2 or 3 year runway, or is this a shorter?
Well, I have my hopes and ambitions, and then I have reality, right, to deal with. No, I think we're, in baseball terms, we're probably in the 7th inning. I think we've got somewhere between, it's interesting, somewhere between 18 and 24 months would be my guess in terms of additional runway. But we've been saying that for the last 12 to 14 months, right? So we have another 24 months.
And then happened on the other hand, there was only another 12 to 18 months before there was a turnaround, and that 12 to 18 months just lasted forever. So.
Well, it's interesting, there are 3 reasons why a market turns. Either you have an economic downturn. We haven't had a huge economic upturn, so I don't know how we would have a huge economic downturn. You have an oversupply situation. We haven't had a lot of oversupply, a lot of supply being built. It's been relatively measured, and I know we're starting to see some now, and we're going to see some between now and 17. Or you have some type of an external event, which you can't really plan for. So from the standpoint of where we sit, it's really, and there's been great capital availability and low interest rates. So from that standpoint, which one of those is going to change? We kind of know what the supply is going to look like. We don't know what an external event would look like. And we really can't predict the economy these days. So I think it's, we could have another 5 years, but I don't think we do.
That's right. As much as we'd like it.
As much as I'd love it.
No. Well, Bill, it's been a pleasure. Really appreciate you taking the time away from the conference, and hope you enjoy the rest of it.
Absolutely. Thank you. Appreciate it.
Thanks very much.